Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments.
Market Update: The Profit Tug-of-War. Macro Constraints to Micro-Realities.
This video presents a direct informational narration of the source document. Let's get right into it.
Section 1. AI Supply Chain Profit War and Asian Tech Impact.
The central conflict brewing right now in the AI supply chain was recently triggered by downstream tech giants complaining about the cost of upstream components. We're looking at a very specific, very public pricing clash here. Apple publicly stated that memory costs have simply become too expensive. Well, this sparked immediate upstream retaliation. Micron didn't back down at all, pointing out that Apple ruthlessly suppressed prices during the 2023 storage industry downturn, which, by the way, stalled industry investment and directly led to the shortage conditions we're seeing today. For years, those downstream tech giants held all the pricing authority. But now, upstream core hardware providers are reclaiming their leverage, and it's turning the AI boom into a fierce battle over who gets to keep the profits.
And when these giants fight over margins, the broader market definitely feels the shockwave. There's real fear out there that if memory chip makers extract too much profit, major cloud providers will ultimately be forced to slow down their capital expenditure, which would hurt the entire AI ecosystem. As a direct result, the Asian markets took a massive hit. The Kospi index plummeted 9% intraday, actually triggering its circuit breaker twice this week. Heavyweights like Samsung Electronics and SK Hynix suffered severe declines, dragged right down by these exact profit friction fears. And as you'd expect, that selling pressure cascaded right into US semiconductor equities.
Section 2. OpenAI IPO delay and macro liquidity constraints.
This brings us to a really clear indicator of today's constrained capital environment. A recent New York Times report shed light on OpenAI's shifting timeline. Originally, the speculative timeline for a massive IPO was 2024. Then, the planned target for a $1 trillion valuation was set for the second half of 2026. However, banker advisory teams have warned that retail liquidity is just too stretched right now. They propose delaying the timeline to 2027 to wait for liquidity to return. But OpenAI, specifically Sam Altman, has reportedly refused to lower that $1 trillion valuation target, which is effectively forcing the delay.
So what does this all mean? The key here is understanding these structural macro liquidity headwinds. Under the Federal Reserve's quantitative tightening, which basically means there's less easy money flowing around, overall market liquidity is being significantly reduced. The capital pool is simply too shallow right now to absorb multiple trillion-dollar AI and aerospace IPOs all at once. We're already seeing SpaceX's post-IPO performance limiting broader market appetite. On top of that, Anthropic and OpenAI are competing in the exact same capital queue. Combine all of this with OpenAI's absolute unwillingness to lower its target, and delaying becomes the most rational mechanical choice so they don't completely overwhelm the market.
Let's look at how institutions reacted immediately to this delay news. SoftBank, which holds a 13% stake in OpenAI, saw its shares drop 13% on the Tokyo Exchange right after the news broke. Wall Street giants Goldman Sachs and Morgan Stanley also saw share declines because they lost this immediate, massive IPO project. But look at the context here. It's fascinating. Morgan Stanley is somewhat buffered by the massive fees they already pulled in from the SpaceX IPO. Plus, both of these banks managed to secure Anthropic's IPO, which definitely helps mitigate the blow from the OpenAI delay. Section 3. Market Mechanics, Hedging, Rebalancing, and Volatility.
So how is the US market absorbing these macro shocks without completely crashing? It all comes down to structural options mechanics and rebalancing flows. Spot Gamma points out that market makers are currently in a state known as long gamma. You can think of this as a built-in shock absorber. To hedge their options exposure, market makers are mechanically forced to buy market dips and sell into rallies. This automated dynamic is exactly why the market's initial lower open didn't spiral into a crash. It effectively locks the broader index in a stabilized trading range.
To put that into perspective, this automated hedging operates at very specific S&P 500 levels. If the index drops to 7,200, market maker hedging kicks in as automated buy orders, acting as a solid floor of support. Conversely, if the market pushes up to 7,400, they mechanically sell into that rally, creating a firm ceiling of resistance. It's totally structural. It literally forces the market to stabilize strictly between those two numbers.
You might have also noticed some wild volatility right at the end of the trading day, but that was actually driven by market plumbing, not widespread panic. The Russell 1000 index underwent its reconstitution, which meant NVIDIA replaced Apple as the #1 weight, and new entities like SpaceX and CoreWeave were officially added to the indices. Crucially,
This Russell reconstitution collided perfectly with the quarter-end rebalancing execution windows for massive pension funds. Passive index funds had to execute trades right at the close. This dual flow impact creates immense mechanical capital rotation, and that's exactly what leads to those false breakdown signals that don't actually reflect the true direction of the market.
Let's map out the technical positioning really quickly. The S&P 500 closed at 7354, locking in a weekly drop of 1.95%. That marks 4 consecutive down weeks. The index has actually closed below both its 10-week and 50-day moving averages. So the short-term trend is certainly weakening, but this deleveraging phase is generally expected to wrap up once the quarter-end rebalancing window closes. Moving forward into July, expectations point to a seasonal recovery, tied to new quarter inflows and dynamics surrounding the election and the U.S. anniversary.
Section 4. Hardware contraction versus software resilience.
We are currently watching a fascinating contrast between a pullback in hardware equities and a capital rotation right into software stocks. First off, a critical threshold to keep an eye on. Bank of America strategist Michael Hartnett noted that the $60 mark on the MAG's Magnificent 7 ETF is the absolute critical sentiment lifeline for the entire AI market right now.
Across the hardware sector, major players are actively testing their critical survival lines. NVIDIA is testing support around $192, sitting right at its annual line in the 0.618 golden ratio. The broader SOX semiconductor index took a heavy hit, dropping 5.3% daily and 8% weekly, testing its 5-week moving average support. Meanwhile, optical communications stock AAOI has suffered a massive 40% pullback from early June. This is essentially a rapid retail positioning unwind following its previous surge in price appreciation.
Just look at the capital rotation happening right in front of us. On the hardware side, you have companies like Micron facing immediate sector sell-offs, even though target prices reached $2,000 and Citi is actively maintaining a bullish stance on the AI trade. But contrast those hardware headwinds with the software rebound. Microsoft jumped 5.7% with highly active $350 call options. ServiceNow surged 9.85%, acting as an incredibly effective hedge. Capital is dynamically shifting from hardware directly into software resilience.
Section 5. Outliers, emerging tech, and crypto-adjacent equities.
While the broader indices are dealing with macro pressures, we're seeing some isolated narratives moving completely independently. Look at these outliers. Corning jumped 14.4% for the week after showcasing its next-generation glass substrates and CPO technology in Seoul. Rocket Lab rose 4.8% on the back of a NASA contract for its Electron rockets, finding solid support at its annual line after dropping 47% from its high. On the flip side, liquidity concerns are heavily pressuring MicroStrategy, which plunged 48% over the month due to fears of a Bitcoin negative feedback loop, with STRC preferred shares sitting at $73.06. Finally, fintech firm Lies rallied 10.2%, driven by a massive $500 million buyback, projected 2026 revenues of $2.5 billion, which is up 19% year over year, and a very healthy pre-tax margin of 26.4%.
Section 6. The next phase, elimination and CapEx scrutiny.
If you take away one single thing from this report, let it be this quote right here. In an illiquid environment, the market's biggest contradiction is no longer the economy, but the profit distribution within the AI supply chain. It's absolutely crucial to understand this. Traditional economic indicators are taking a back seat. The primary constraints dictating the market right now are structural liquidity and the internal friction over AI profit margins.
Which brings us to our final, overarching structural shift. We are officially seeing the transition from the early, indiscriminate buy-everything AI market phase into a ruthless elimination phase. Going forward, the market will be governed by intense scrutiny of hyperscaler capital expenditure, or CapEx. The survival of this AI bull market now heavily depends on sustained tech giant CapEx. As these margin pressures continue to squeeze the entire industry, the real question we have to ask ourselves is, which tier of the supply chain will actually survive this elimination phase?